Okay, so get ready for it. This is maybe the most important video of the entire class because we're going to be talking about the accounting equation. And this is the basis upon which the entire kind of accounting system is based on. So I'm just going to first just write out what the accounting equation is, and we're going to define some terms, and then we're going to go back and revisit the equation and dive into more of the details. So the accounting equation is assets equals liabilities plus equity. So you can think of it as ALE, assets equals the sum of liabilities plus equity. Okay, so now let's define what these terms are. So what is an asset? So an asset is an economic resource that is going to benefit the business in the future. Okay, so um, what is the most common and useful asset? Cash. Okay, why is cash an asset? Because cash can be converted into pretty much anything that your business is going to need. It can be converted into labor because you can pay your workers with cash. It can be converted into a vehicle, a car. It could be converted into machinery. You can buy land with cash. So all the things that you need to kind of operate your business, you can use cash to obtain it. So it is kind of the king asset, you can say. Um, Other examples of assets, inventory. Okay, so if you are Target, when you buy, let's say you're selling um, soap in your store, when you first pay the soap maker for that bar of soap that you're going to have in your store, it's something that you own. Okay, so this is an important kind of concept of an asset. It represents what your company owns. And so when you buy that soap that's now sitting in your store, it you haven't yet kind of realized the benefit of it because it's only going to happen when you sell it. So until that time, that inventory is an asset that your company owns that's going to give you the future benefit of a sale, right? You're going to generate what we call revenue from the sale of that particular inventory item. So until you actually sell it and generate that kind of revenue, that profit, it's going to be held and considered an asset of your business. It's something, again, it's an economic resource. It is something that you can convert to cash. Eventually, you're going to sell it. You're going to hopefully sell it for more than what you paid for it, and you're going to generate a profit from that sale. Equipment. So this is pretty straightforward. If you're, let's say you're Tesla and you're making cars, you have this equipment in your factories that you're going to be using for years. And that equipment, of course, you had to purchase it. Okay, so we're going to talk about how, you're going to buy this equipment and you're going to use it up, but it's going to benefit your company over many future periods. So when you first buy it, it's considered an asset. It's going to deplete in value. We'll talk about how to account for that. But the fact that it's going to give us future benefit makes it an asset. Similarly with vehicles, you buy this thing that you're going to, let's say you're FedEx, you buy those vans, you're going to use it for many years. So you're going to get a future benefit from that purchase. Real estate, this is also an asset because your company can use it to have its offices, its warehouses, whatever. Um, Even if you didn't use it, it's also an asset because it has a value, and usually real estate, even land, bare land, uh, is going to go up in value. You could sell it for cash, so it is also, it has use, and it is a store of wealth or cash or value. You can say it's a store of value. Okay. I'm saying cash because you can sell real estate. Of course, there's transaction fees and all that and some friction, but it can be converted to cash. Buildings, uh, usually buildings and real estate come together. Um, but the building wears out. Land, if you own land, that does not really wear out. in the way that like equipment or vehicles or a building wears out. But a building is going to be treated kind of similarly as equipment and vehicles in that you buy it for some amount, but then you're going to have to account for the fact that it's losing its value over time because it's being used. Machinery, similarly to equipment. And another type of intangible asset is called intellectual property. So it's called intangible because intellectual property assets like patents, copyrights, these don't exist in the physical world, but they do have economic value to your business. So if you own a patent, it's going to be good for a certain amount of years in which you kind of have a monopoly on whatever product you've patented. So it has a value. Okay, so you could even sell patents. Okay, so you could realize a value and sell it for cash. So though these are not existing in the physical world, they're just kind of legal realities. They do have a value and are considered assets. And so, in summary, basically, assets are anything you own and can be used productively, with the caveat that some assets are just stores of value. So, like I mentioned, land, you could buy art, right? So, if your company is an art dealer, okay, you could have art as actually part of your inventory. Okay, so though it's not being used productively, it is a store of value. It's worth something and you own it. So it's considered an asset. Now, you also have to be careful when you're determining the difference between an asset and an expense. Okay, for example, um, if you're paying for research and development, okay, you could argue that research and development is something you're spending money on now, and it's going to have a future benefit because you're hoping to basically um, benefit from that research in the future by creating a new invention or whatever. However, in our accounting rules, we treat this as an expense, meaning that we're not getting a future benefit from it. An expense is something that you're going to spend money on, and you're just uh, either paying for it because you've already used it, or you're just going to use it right away. So, for example, when you pay your utility bill, this is not an asset. Why? Because the electricity you've used when you pay your utility bill, you've already used it and you're just paying for that use that's already happened. So that violates this kind of rule of an asset where it has to be kind of giving you some future benefit. Okay, so we're going to talk about how we account for utility bills. But, a utility bill, you're spending cash. And equipment, when you're purchasing it, you're also spending cash. But again, the difference is that the equipment is going to give you um, future value, future benefit. So you're not going to treat it like an expense. You're going to hold it in your accounting records as an asset. And we're going to show you kind of how to do this with examples later. Okay, liability, I think, is a little more straightforward. Um, it is just anything that your company owes. Okay, so whenever you borrow money, this can be from people like a bank. If you issue bonds, which is kind of like a way of borrowing money, your company is now owing money. They have to pay back money. Okay, um, you can even have liabilities to your customers. Okay, so what is an example of this? An airline, when you buy your airplane ticket, you're going to pay money for that ticket, and maybe you're not going to fly for a month or two. So you've given money to the company, and they owe you a flight, right? They haven't given it to you yet. They've taken your money, they've essentially borrowed that money, but they owe you something. So in that case, you're going to have, United Airlines or Southwest, they're going to have a liability to their customer for this service that they're going to have to provide. We're going to call this unearned revenue. Okay, we're going to see later as we progress unearned revenue. This is money that the company has taken, but it has not yet provided the services or goods that it took the money for. Another example is a attorney. Okay, when you take a retainer from a client, they're going to pay you upfront for the money or for some services, but you as an attorney haven't done a single minute of work yet. You're just taking their money, and as you do the work, you're going to use that kind of cash to pay yourself. But until you've done something, it's a liability. If the customer gives you that cash, and let's say 5 minutes later they change their mind, you're gonna have to pay them back, right? You're gonna have to give that money back because you haven't done anything to earn it. So that is kind of the hallmark of a liability. It's you have to pay that amount back to whoever kind of lent you the money. And then finally, we have equity. This represents ownership. Okay, so this is definitely the trickiest part of this accounting equation. Um, a lot of action is happening in this equity section. We're gonna kind of break it down in the next slide. But you can, in short, it's basically um, what the owners of a business have as their net worth. Okay, so you can think about it as even you as a person. If you have, if you own a house, if you own a car, if you own cash in your bank account, let's say that all totals 100K. But, and so these are your assets. But then let's say you have a mortgage of 50,000. Okay, that's a liability. Now what's left over is your net worth, which is 50K. So you can see here kind of how this is all going to work. This framework of assets equals liability plus equity is a general way of it's a there's a symmetry here. Okay, we're gonna kind of see how this symmetry works, but it applies not only to business but to personal finance, to any kind of um, financial related topic. You can apply this framework of assets equals liabilities plus equity. So here we have the equation again written out. As I stated, there's a lot of action happening in this equity section. So let's think about what's going on here. So we can break out equity into this first kind of sub equation. Okay, so this is the first kind of level. So there's two ways that kind of the owners of a company, or let's say you're buying a house, um, how you kind of contribute equity. The first is how much you've actually put in. Okay, so if you're a business, your shareholders are going to contribute some amount of capital out of their personal pocket and contribute it to the business. This is going to be to their credit. This is going to be contributed capital. So let's say you're starting a startup company and you as the owner contribute $100,000 of your personal money to the business. So what is going to happen is you're going to take $1,000 cash out of your bank account and transfer it to your business's bank account. So what do they have? Now they have 100K in cash. They haven't borrowed anything yet, but you've now contributed 100K in this contributed capital bucket. Okay. So you can already see that the equation is balanced. Okay. And my claim is that at every point in time, after every transaction in a business, this equation will always, at every point in time, be balanced. Okay. And so we're going to do some examples and I'm going to prove this to you. But the key thing to remember is that this symmetry is going to be maintained throughout the life of a company at every moment. Assets are always going to equal the liabilities plus equity. Okay. As events unfold with the business, this equation is going to change. The balances will change, but the symmetry between the left side and the right side, it's always going to be balanced. Okay. So this other part, retained earnings. So what does that mean? So let's say we started this business with $100,000 and I am a plumber. Okay. And let's say the next day I go out and do a job and the customer pays me $5,000 cash. So what has happened? I now have $105,000 of cash. I didn't borrow any money, but and I have the original 100K that I contributed. And but now I've earned some money. Okay, so that's what's happening in this retained earnings. okay, as the name implies. You're gonna have whatever is happening to the operations of the business in terms of profit and loss is gonna be living in this retained earnings. So in this case, I earned $5,000 of what we call revenue. Okay, this is the service I provided as a plumber. I generated a benefit to my company through providing that service, and we call that a revenue. So you can now see that this equation is still balanced. It's 105,000 on both sides. So let's look at this retained earnings part in a little more detail. So this next equation is basically breaking out this retained earnings a little bit. It's basically this here. Okay, so contributed capital is going to be in the form of what we call common stock. So this is ownership in the company, and we kind of saw and talked about some history about common stock, but this represents what you've given to the owners of your company in exchange for the capital they've contributed. They now have the stock, which represents an ownership interest in the company. Now, retained earnings has two parts. It has the net income, which you can think of as the profit that the business has generated. And then it's subtracting. So notice this. This is a key thing. Minus dividends. So what is a dividend? A dividend is when the company, remember we have this entity, our business, it has cash sitting in its bank account. Now, at some point, maybe the business decides we have a bunch of cash. Let's distribute this out to our individual shareholders. Okay. This distribution is called a dividend. When value is taken out, when you're taking cash out of the business and distributing it to your shareholders. That's why this is a subtraction. It's basically it's reducing the retained earnings because you're taking whatever profit had been generated, and you're paying it, you're distributing it out to your shareholders. So that's going to kind of reduce this equity balance because you're taking it out of the business and you're moving it outside and you're kind of giving it to your shareholders. They like this because it's now gone from the business entity, from this holding cell into their personal pockets. But of course, it's taking away from the business. Yeah. Um, so now in this third equation, we still have common stock. That's again part of this contributed capital. We have dividends. It's the same as above. But now we're further breaking out what is net income. It is your revenues minus your expenses. So remember I talked about the utility bill. The utility bill is going to come into here. It's actually going to be part of, uh, it's going to flow into our balance for equity. Okay. Because that utility bill we paid is not giving us any future benefit. If it was, it would be kind of listed as an asset here. But instead, since we paid it out, it's like kind of an expense for our business. The owners of the business are kind of eating that, you can say. Okay, so, but of course, they're getting the benefit of the revenue, which we saw in this plumber example. So, just to show an expense here, what if we paid, let's say, $1,000 for a utility bill? Okay, so I'm a plumber. I earned $5,000 of revenue, which appeared here, but now I'm paying $1,000 for rent. So now my cash balance is going to go down to 104. I haven't borrowed anything. My liabilities is still zero. My contributed capital is still 100. My revenue is 5,000. But now I'm subtracting, you can see here again, subtracting 1K because I just paid an expense. So you can still see here that it balances. This right side of the equation is also 104. Okay. So again, this is the pattern. This balance, this symmetry is going to be maintained throughout all these transactions. There is a transaction here where we sold common stock for cash. We got this cash and we sold this common stock. And this one we generated revenue. That was another transaction. And then this one we're paying an expense. So in each transaction, our balance, our accounting equation, balance is maintained. So let's just define a couple things about transactions. So what is a transaction? It is any event that affects the accounting equation, essentially. Okay, so it's anything that's going to affect this financial position of the business, and it has to be measurable. Okay, if something has happened, let's say you're a biotech company and you make some discovery about, a new drug, you can't yet account for it because you don't know the true value of that discovery. Now, if you looked at your stock price, the stock is going to go crazy, okay, if you've made some substantial discovery. So the stock market, the people who are investing are going to attribute some value to that. But your accounting books, this assets equals liability plus equity, since you can't really measure the value of um, that event, it's not yet going to transact. Let's say you made the discovery and then you sold it to another, to Pfizer or something for $1 billion, then you can treat that as an event. You're going to get $1 billion of cash and you're going to have, revenue of $1 billion. But it's only at that time where that value of that discovery is transacted upon. That's the event that is going to affect the your business in a way that you can actually account for it. So we also have accounts. This is a way that we can split up our assets into all its different, like, you have cash, you have land, you have equipment. You're going to break up your assets and so that you can better communicate what your assets are to your the users of your financial statements. We're going to see how basically we're going to arrange all this stuff in our kind of in this assets equals liabilities plus equity. This equation is going to be a financial statement that we call the balance sheet. Okay. So you want to be able to say what all your assets are. You're going to have to show what types of liabilities you have because there's different types. And then you want to also show in accounts in different in ways that break out this equity into its constituent parts. It's more communicative to your financial statement user when you have accounts that are kind of keeping track of these individual types of assets, liabilities, and equity. And again, this symmetry between the two sides of the equation is always going to balance out. We're going to do some examples to show that. So why don't we switch to that now?